As imports are a big part of the GDP figures, and imports actually create a negative effect to GDP. Afternoon, we have Fed minutes, a GDP revision, and a great tax planning scenario that I thought I would share here this week that I think hopefully will help quite a few of you. My name is Brandon Steele, financial advisor with Mainsail Financial Group, where we aim to leave you feeling more empowered after every interaction. And our goal in these weekly updates is to break apart some of the news, the data, the trends that we're watching, and kind of weed out some of the noise along the way. So we have a couple of things to cover on the data point, but a really, really exciting, I think, tax planning scenario that we've run into here recently that might have some kind of basis for a lot of you to consider in your own strategies as well. I will highlight before I jump in, just keep in mind it was a shorter week here this week with the market closed for Memorial Day. So hopefully you had a great holiday weekend. But then we got right back into things on Wednesday. So on Wednesday, we had the Fed minutes come out from the most recent meeting. Honestly, there's not a whole lot to report here, especially for those who did tune into our debrief from the Fed meeting. It's really a similar story to what we heard in that press conference. The short version of it is that, the Fed is seeing some risks to inflation, jobs, and stability. Really, it mostly highlighted this potential challenge that they see on the horizon, where if we do see higher inflation and lower employment, how does that translate to what they do from a monetary policy perspective? So again, nothing really new there. They kind of reiterated, I should say, what Fed Chair Powell keeps sharing, which is that they feel like they're well positioned to wait. So that's kind of the general takeaway. Not a whole lot to report necessarily, but hopefully that does help, kind of a reminder maybe of what came up in the Fed press conference more than anything else. Fast forward to today on Thursday, we also got the first GDP revision for Q1 GDP. For those who do remember, it came out at minus 0.4% originally. Today, that revised number is still down, but down 0.2%. So it was revised up to a degree from where we stood previously. Now, in case you missed the week where we discussed this GDP, I do want to remind you to take this with a bit of a grain of salt. The reason I say that is because imports are a big part of the GDP figures, and imports actually create a negative effect to GDP. So as you might imagine, and again, for those who maybe didn't catch that Thursday's update, we saw a huge level of imports in Q1 in anticipation for tariffs as companies kind of like loaded up the shelves. And so that had a big impact on GDP. It doesn't mean don't take this number seriously. It just means that had a dramatic impact on what we saw for the total GDP or growth numbers, in this case, lack of growth numbers. But I just want to kind of reiterate that because that is an important factor in this GDP number. And obviously, as we look to Q2, it'll be really important to watch what comes up there. Before we break and kind of go over this general kind of case study scenario, I do want to highlight, be sure to tune in next Thursday because we have a ton to cover. We have inflation data, income and spending, all ahead of jobs week as well. So a lot to cover here next Thursday. But before we break for the week, a great case study that I wanted to address. So we had a recent conversation with a client really about tax planning and how they might prepare for required minimum distributions when they are kind of forced to take money out of their IRAs, and in this scenario, pay a lot more taxes than they really need to or should. So they had just retired, and so their income has decreased pretty significantly from last year. And now they're really looking for ways to reduce taxation, reduce those future RMDs, and just kind of use the resources that they've got to be more effective down the road. One thing that's really important to highlight is that this couple actually gives annually for charitable giving to the tune of about $10,000 a year. And they typically take the standard deduction because some of those gifts and their other deductions just don't quite add up to the maximum. So what we had discussed is this idea of bunching gifts. So rather than doing $10,000 a year, one of the things we discussed is potentially bringing 5+ years into one given year, and maybe looking at contributing that to what's called a donor advised fund. So for those who aren't familiar, this could allow you to basically put a big chunk away for charitable interests, take some of the tax benefits in the year you make that contribution, but then it actually gets invested into an account, which you can spread out the distribution. So they in this example, they can still do $10,000 a year. They distribute from that donor advised fund to actually send to the charities directly. But again, you are able to kind of reap the rewards or the tax benefits of a larger contribution all at once. Now, the big thing, and why I wanted to bring this up, is because we also coupled this with this idea of Roth conversions. And this is where the real opportunity came in. Rather than just converting and paying all this extra tax, which was kind of the plan, we're kind of pairing these two strategies together in 1 year to help reduce the tax impacts of those Roth conversions, and essentially allow them to be a lot more aggressive with some of those Roth conversions and create tax-free money in the future. Now, I want to be clear. Hopefully, this is helpful, but I want to be clear. There's a lot to this. The strategy definitely does not work for everybody, and there are a lot of nuances to explore. For what it's worth, not everybody needs to look at either of these strategies either, right? Not everybody needs to do Roth conversions. Not everybody needs to do donor advised funds. So please take this with a grain of salt as well, and know that your situation will vary. But hopefully this gives some ideas to kind of open up some brainstorming or some things to consider. And mostly the reason I wanted to highlight this is because this really points to the idea of how you can explore multiple strategies, kind of coupling those together to create a much larger impact over the long term. So hopefully this is helpful. Again, something that that comes up actually a decent amount too. So I thought we would kind of share this general concept, and hopefully that helps for you in some of your planning, or at least your thoughts moving forward. With that, we'll break for this week. Be sure to tune in next Thursday. Again, we have a lot to cover with inflation, income, spending, and the start of jobs week. So we'll be sure to catch you up on where we stand at that point. In the meantime, have a great upcoming weekend, and we'll see you next Thursday at 3.